Chapter 16, How to Read, Analyze, and Interpret Financial Reports. In Learning Unit 3, we discuss trend and ratio analysis. We'll explain and complete a trend analysis and list, explain, and calculate some key financial ratios. There are many tools available to analyze financial reports. When data covers several years, we can analyze changes that occur by expressing each number as a percent of the base year. The base year is a past period of time that we use to compare sales, profits, and so on with other years. This is called trend analysis. There are two steps to completing the trend analysis. First, select the base year. This will be 100%. Second, express each amount as a percentage of the base year, rounded to the nearest whole percent. It is possible that the amounts may go over 100% if the year is higher than your base year amount. So for example, we're given this information for a company for 4 years, 2018, 19, 20, and 21. We're given sales for each year, gross profit for each year, and net income. We're told our base year is going to be 2018. So we want to do a trend analysis on sales, gross profit, and net income based off of 2018. So these are our trend analysis. We see, for example, that in 2019, our sales were $340,000 divided by our base year of 420, we get 80.95, which is rounded up to 81%. And looking at sales, you'll see the base year is always 100%. This year, sales was lower than the base year, so we expect that percent to be less than 100. In 2020 and 2021, the amounts are larger than the base year, so we expect these amounts to be over 100%. Remember, your base year is always 100%. Another tool companies use to analyze performance by companies is ratio analysis. A ratio is a relationship of one number to another. Many companies compare their ratios with those of previous years and with those of other companies in the industry. It is important to choose companies with similar industries when you're comparing ratios. Percentage ratios used by companies to determine the following: how well the company manages its assets. These are asset management ratios. The company's debt situation, debt management ratios, and the company's profitability picture, profitability ratios. So here's a summary of the key ratios on page 430 in your book. The current ratio is current assets divided by current liabilities. So you'll see the actual calculation here, what it means, and how questions can be raised. So current ratio, for the example, 61,000 divided by 92. The current ratio is 6.66. That means a business has 66 cents of current assets to cover current debt. That's not a good ratio. You want to have enough current assets on hand to pay off your current debt if you need to. Thus, the industry average is 2-to-1. The acid test or quick ratio is similar to the current ratio, except the top part of the fraction is current assets minus inventory minus prepaid expenses divided by current liabilities. We're talking about quick assets here, things that can be quickly and easily converted to cash. So in our example, it takes the total current assets, subtracts out the inventory and prepaid expenses, and divides by the same base, and you see that it's now 0.17. The ratio is even worse than it was when we looked at the current ratio. The business has only 17 cents to cover each dollar of current debt. Average days collection is accounts receivable divided by net sales divided by 360. This tells you how many days it takes to collect an account receivable. Again, this is a high average compared to the industry average. Debt to assets. total liabilities, which is your debt, divided by total assets. We see that they have 73.17%, which means that for every dollar of assets, the company owes 73 cents in debt. So it's slightly higher than the industry average of 50 to 70%. Return on equity, your net income divided by your stockholders' equity. We'll see it's 11.48%. So for each dollar invested by the owner, the return is 11 cents. Not as high as the industry average. Asset turnover, net sales divided by total assets. We see is 10%. For each dollar invested in assets, it returns 10 cents in sales. Profit margin on net sales. We discussed this in one of the previous examples. Net income divided by net sales. We see is 30.71%. So for each dollar of sales, the company produces 31 cents of profit, which is right within the industry average. So let's look at an example. Find the following ratios for Motorola Credit Corporation's annual report: total debt to total assets, return on equity, asset turnover, and profit margin on net sales. Round to the nearest 100th percent. So this information is given is your net sales of $265 million, net earnings of $147 million, total assets of $2,015 million, total liabilities of $1,768 million, and stockholders' equity is $427 million. So in the first example, we want to calculate total debt to total assets. So the formula for that is total liabilities divided by total assets. Our total liabilities is $1,768. Our total assets is $2,015. $1,768 divided by $2,015 is 87.74%. B, we want to calculate the return on equity. Return on equity is net income divided by stockholders' equity. So our net income is 147. Our stockholders' equity is 427. So we have a return on equity of 34.43%. C, asset turnover to the nearest cent. Asset turnover is calculated as net sales divided by total assets. Net sales is $265. Total assets is $2,015. $265 divided by $2,015 is 0.13, 13 cents. Make sure you notice that this is cents, not a percentage. D, profit margin on net sales. For profit margin on net sales, we take net income, 147, divided by net sales of 265 to get 55.47%.